Welcome to The Explainer. Today, we're breaking down a topic that often feels incredibly backward, honestly, even to seasoned investors. We're talking about the mechanics of how the bond market actually works. If you've ever looked at bond prices and felt like the math was operating in some kind of parallel universe, well, you're in the right place. We're going to visually unpack exactly how these assets are priced, traded, and evaluated.
Let's kick things off right away with a massive paradox. If a bond is essentially a contract promising a fixed payout, a specific interest rate over time and your principal back at the end, why on earth does its market price bounce up and down every single day? It seems totally counterintuitive, right? Well, that paradox is the gateway to understanding what we call the teeter-totter concept of finance, and it's exactly what we're going to explore today.
Okay, let's dive into this. Here's our roadmap. We're going to look at the core of valuation, decode premium and discount jargon, peek inside the decentralized market, figure out exactly who buys these things, uncover the real risks, and finally, look at how we track the market.
Part 1. The core of bond valuation. Let's unlock the math behind the market.
Before we can understand the market, we've got to unlock the underlying math. At its most basic level, a bond's market price is really just the present value of all its expected future interest and principal payments. But to actually find that present value, we need a mathematical anchor, and that's the yield to maturity. This is a super crucial piece of jargon. Yield to maturity is simply the rate of return used to discount those future cash flows back to today's dollars. Think about it. If a bond's redemption yield strays too far from the current market interest rate for other similar bonds, arbitrage opportunities would pop up instantly. So, yield to maturity acts as a tether, keeping the bond attached to broader economic reality. So, the absolutely crucial point here is this fundamental inverse relationship. Think of it as the giant teeter-totter of finance. When market interest rates rise, the price of existing bonds must fall. Why? Well, if I can go out and get a newly issued bond paying a higher, updated interest rate elsewhere, I'm certainly not going to pay top dollar for your older bond with a lower payout. No way. The price of your bond literally has to drop to make its overall yield competitive with those new rates. And of course, the reverse is true. If rates drop, your older, higher-paying bond suddenly becomes a hot commodity, and its price shoots up. Let's move along and see how this builds. Section 2, Premium, Discount, and Par. Time to decode the everyday jargon of bond prices. A bond's market price is almost always expressed as a percentage of its nominal, or face value. 100% of face value is what the industry calls at par, which corresponds to a price of exactly 100. So if your bond is priced above 100, maybe because its fixed interest rate is looking incredibly attractive in the current market, we say it's trading at a premium. Pretty straightforward. And if it's priced below 100, it's trading at a discount. Let's make that math completely concrete for a second. In the US, most government bonds are denominated in units of $1,000. So if you're looking at a deep discount US bond quoted at a price of 75.26, you aren't just paying $75. Remember, that quote is a percentage. It actually translates to a selling price of $752.60 per $1,000 unit. Now, what's really fascinating is this concept of pull to par. Even if a bond is currently trading at a really steep discount or a hefty premium, its price isn't going to stay there forever. As the bond approaches its maturity date, its price will naturally gravitate right back toward that 100 mark. It's almost like gravity for bonds. This happens because, assuming the market expects the issuer to pay in full and on time, 100 is exactly the price the issuer will pay to redeem the bond. Time literally pulls the price back to face value. But there's a slight wrinkle when you actually hit the button to buy or sell. You've got to know if you're looking at a clean price or a dirty price. Bonds pay interest periodically, right? Say twice a year. If you buy a bond halfway between those payment dates, the seller is still owed half of that interest. The dirty or full price includes that accrued interest since the last coupon date. The clean or flat price strips it out. Different markets handle this differently, but it's absolutely vital to know if your quote is clean or dirty so you don't get taken to the cleaners at settlement. All right, Section 3, Inside the Decentralized Bond Market. Let's look at how bonds actually trade. This is where we shift focus from the math of a single bond to the massive ecosystem where these trades actually happen.
And it brilliantly illustrates a key difference in finance. Unlike shares of, say, Apple or Tesla trading on a highly visible, centralized stock exchange, most developed bond markets operate over the counter, or OTC. It's a completely decentralized network. When you buy or sell a bond, your counterparty is almost always a bank or a securities firm acting as a dealer. These dealers provide market liquidity by carrying bonds in their own inventory. They're committing their own risk capital, which means they are the ones directly absorbing the risks of price fluctuations while holding onto those bonds. Section 4. Who buys bonds and why? Let's meet the institutions driving the market. So who is on the other side of these dealer transactions? Well, while it's totally true that everyday investors buy bonds, usually through mutual funds, U.S. households hold nearly 10% of all bonds directly. But that means the vast, overwhelming majority of the market is driven by institutional money. We're talking central banks, sovereign wealth funds, pension funds, and insurance companies. Why? Because these giant institutions have predetermined liabilities. They know exactly how much they have to pay out on specific dates in the future, and they use the fixed payouts of bonds to perfectly match and fund those liabilities. Moving to Section 5, the real risks of bonds. It is time to shatter the illusion of perfect safety. Because bonds provide that predictable, fixed payout, they're universally viewed as the safe part of an investment portfolio. Actually, scratch that. It's an illusion. When you own a bond, you're facing a literal gauntlet of potential risks. A rating agency like Standard & Poor's could issue a sudden downgrade, sinking your bond's price. The issuer could call the bond early when rates fall, forcing you into reinvestment risk. You face liquidity risk, inflation risk, but the single biggest threat to the everyday portfolio, and the one we really need to focus on, is interest rate risk. This ties right back to our teeter-totter metaphor. Interest rate risks strikes immediately. If prevailing market interest rates rise, the market value of existing bonds falls. Period. And this matters immensely to us because if you hold bond mutual funds in a retirement account, the value of that portfolio drops the moment those bonds are marked to market. Long-term investors holding a single bond to maturity might ignore the price swings. But if you need to cash out of a fund early, that interest rate risk becomes very, very real. And then, of course, there's the ultimate risk, default. If a company goes bankrupt, its stock goes to zero. Now, bondholders do enjoy legal protection, and they're closer to the front of the line to get some money back from liquidated assets, but it is rarely 100%. Just for a stark reality check, after an accounting scandal and a Chapter 11 bankruptcy in 2004, bondholders for the telecom giant WorldCom ended up being paid just 35.7 cents on the dollar. To put that into perspective, absolute safety is a complete myth. Finally, Section 6, tracking the market. How do we actually measure bond performance? With all this complexity and risk floating around, how do professionals keep tabs on the health of the ecosystem daily? They rely on bond indices. These act exactly like the S&P 500 or the Russell indexes do for stocks. You've got the Bloomberg Barclays U.S. aggregate acting as a massive general market tracker, alongside indices from Citigroup and Merrill Lynch. These benchmarks help managers track specialized global portfolios, allowing them to navigate the OTC market and measure just how well they're dodging those interest rate and credit risks. Which brings us to our final thought. We've seen the teeter-tatter in full swing. We know that if market rates rise, bond prices absolutely must fall. We've seen that default and painful bankruptcies are very real events, not just textbook theory. So, what does this all mean? Is the traditional safety of bonds just a matter of perspective? Look, if you're a massive institution matching a 30-year liability, maybe it is safe. But if you're an everyday investor relying on a bond fund for stability and a rising rate environment, you might want to look a little closer at what you actually own. Thank you so much for joining me for this explainer. I really hope this helped demystify the incredible mechanics of the bond market for you.